If your money is sitting in a savings account right now, you're probably earning around 0.5% to maybe 4% if you're lucky, and even then, inflation is quietly eating away at your purchasing power every single year. In this video, I'm going to walk you through 10 stocks that have historically outperformed savings accounts by a wide margin and, more importantly, why investors continue to watch them for long-term growth potential. This isn't about getting rich overnight, and it's not financial advice, but it is about understanding where long-term wealth has actually been created in the stock market versus where money just sits and slowly loses value. Let's start with Apple. Apple is one of those companies that almost feels too obvious, but that's exactly why people underestimate it. It's not just about iPhones anymore. It's a full ecosystem of devices, services, subscriptions, and customer lock-in that keeps users spending year after year. Over time, Apple has consistently grown revenue, expanded margins, and rewarded long-term investors through both stock appreciation and buybacks. While a savings account gives you predictable but tiny returns, Apple has historically compounded value at a level that completely changes what long-term capital can become. Next is Microsoft, a company that has transformed from a traditional software business into a cloud computing powerhouse. With Azure competing directly in the cloud space and strong dominance in enterprise software like Office and Windows, Microsoft has positioned itself at the center of modern business infrastructure. What makes it powerful is its recurring revenue model. Companies don't just buy Microsoft products once, they subscribe year after year. That consistency is a big reason why it has significantly outpaced traditional cash savings over long periods. Now we move to Amazon, which continues to dominate e-commerce and cloud computing through AWS. Even though retail margins are thin, Amazon makes up for it with scale, logistics efficiency, and one of the most powerful cloud platforms in the world. AWS alone generates massive profit streams that support long-term expansion. Amazon has always reinvested aggressively, which sometimes slows short-term gains, but historically that strategy has led to major long-term stock appreciation that far exceeds what money sitting in a bank account can do. NVDA is next, and this one has become one of the most important companies in the world due to artificial intelligence. NVIDIA designs the chips that power AI models, data centers, and advanced computing systems. As AI continues to expand across every industry, demand for high-performance chips has surged. While NVIDIA is more volatile than traditional blue-chip stocks, its growth trajectory has been one of the strongest in the market in recent years, showing how technological shifts can dramatically outperform safe cash savings. Google, or Alphabet, is another core holding in the tech world. Its dominance in search advertising is still unmatched, and YouTube continues to grow as one of the largest platforms on the internet. On top of that, Google Cloud is becoming a stronger competitor in the cloud space. With massive cash flow and deep investments into AI, Alphabet remains one of the most stable yet growth-oriented companies in the market, consistently outperforming low-yield savings over time. Now let's shift away from pure tech and talk about Costco. Costco is interesting because it's not flashy, but it's incredibly consistent. The membership-based model creates stable revenue, and the company thrives even in uncertain economic conditions because consumers always look for value. Over time, Costco has rewarded long-term shareholders with steady growth and resilience, proving that you don't always need high-risk tech stocks to outperform a savings account. Visa is another quiet powerhouse. Every time someone swipes a card, Visa takes a small cut. It doesn't take on credit risk, and it doesn't need inventory or physical products. It simply processes payments across the global economy. As cashless transactions continue to grow worldwide, Visa benefits directly from that trend. This kind of scalable business model has historically produced returns that far exceed traditional banking interest rates. Next is Broadcom, a company deeply involved in semiconductors and infrastructure software. While it may not get as much attention as NVDA, Broadcom plays a critical role in networking, data centers, and wireless communication systems. It also has a strong history of acquisitions and consistent dividend growth, making it a blend of growth and income that has performed very well over long periods. Meta is another major player, focusing on social media and digital advertising. Despite volatility and public scrutiny over the years, Meta has remained one of the most profitable advertising machines in the world through Facebook, Instagram, and WhatsApp. Recently, its push into artificial intelligence and virtual reality shows it is still betting big on the future. When the company executes well, the upside potential has historically been far greater than anything a savings account can provide. Finally, we come to something a little different, an S&P 500 ETF like VOO or SPY. Instead of picking individual stocks, this gives you exposure to the top 500 companies in the United States. Historically, the S&P 500 has returned significantly more than savings accounts over long periods, driven by the growth of American businesses as a whole. It's not the fastest or most exciting option, but it is one of the most reliable ways to build long-term wealth through the stock market. Now here's the important takeaway. The reason these stocks outperform savings accounts isn't because they are risk-free or guaranteed. It's because they are tied to businesses that grow, innovate, and expand over time. Savings accounts are designed for safety, not growth. Stocks, on the other hand, are ownership in real companies that can scale revenue, increase profits, and compound value over years and decades. The key lesson here is understanding trade-offs. Savings accounts protect your money in the short term, but they rarely build wealth in the long term. Stocks introduce volatility, but they also introduce opportunity. And historically, that opportunity has been the difference between just saving money and actually building financial independence. If you found this video helpful, don't forget to hit that like. Also, if you're new, don't forget to subscribe to the channel. I'll catch you in the next one.